Carnival Cruise Corporation is up almost 13% today. It is currently trading at $14.70 a share. The reason for this, JP Morgan has upgraded Carnival Cruise Line stock on travel sector boom. What we're going to be doing today is talking more about what's happened here, what the stock price has been doing, then looking at the financials of the company to see if it's a buy or a sell. We're going to be looking at my automated stock valuation spreadsheet using discounted free cash flow model, the Ben Graham model, and the comparable companies model to see if Carnival is a buy or a sell. So as I said, JP Morgan upgrades Carnival Cruise Line stock based on travel sector boom. It was upgraded from upgraded to overweight from neutral, and what the Yahoo Finance here says is that JP Morgan upgrading Carnival this morning to overweight from neutral. This is due to momentum for the cruise industry in the upgrade. And then they had the Carnival CEO Josh Weinstein talking. We had record numbers. We just got through the wait period. We have the highest booking in the industry. We literally have the most booking in history in a company of a 3-month period. And in order for North American brands and European brands, it took us a little bit longer on that flow. So frankly speaking, between that and our first quarter result, we beat on every single line item. Things are trajectory inaudible. Well, I'm guessing on the right line there. So very good news coming out from them. Let's see what's happened to the stock over the last few years. This pre-pandemic was a $50 stock, dropped down massively to $8 a share. That was pretty much at the bottom. Kind of had a good upgrade in 2021, then dropped back up again, $28 a share. It's down almost 64% since then, but is on the upswing. So can this get back to the $50 stock it once was? Well, that is the question. Before we continue, please give a like on the video. It really helps me out. Subscribe if you're not already, and let's get into it. So this is my automated stock valuation spreadsheet. Firstly, we'll just type in the ticker CCL, and this will load up all the financials and details about the stock that is important. So obviously the price, $14.77, up about $1.68, 12% in the day, 18 billion market cap, does not have a PE, has negative earnings per share, and has a very high beta of 2.21, which means it moves significantly more than the market. Shares 1.3 billion. They had a share buyback, as you can see here. Dividend, they did not pay a dividend. They did used to, but obviously COVID has messed that up. So if we look at the numbers here, firstly we have the revenue numbers. This is from 2018 to the trailing 12 months, and 18 and 19 had a 19 and 20 billion respectively. 4.2 down to 2, strong rebound in 2022, and then once again it's increasing again. So revenue is up, and that is what we like to see. Net income, this is the problem here. It's in negative right now. They're losing money. They're not making any profit. Previously they were about 3 billion, and this is negative since then. Shares outstanding. They were issuing more shares. They have been issuing more shares, and then you can see it is now here. So I'm guessing they did a buyback, or the website I'm using has the incorrect numbers. But if we kind of ignore the 2022 number, you can see that they have been steadily issuing more shares, which is obviously a bad thing. Then on the free cash flow negative as well, was 1.8 billion, down to pretty much even, 0, and then negative progressing there. So the real numbers we're looking here is revenue and net income. So if we just take it to our discounted free cash flow model, obviously it is not going to like the stock because it has negative free cash flow, currently a 34-cent stock. So what we will do is we will see what happens if it gets to about that 3 billion of net income it previously did. What would the stock be? So let me just change some numbers here to see what it is. Revenue growth rate, obviously it is growing, but we'll leave that there. Let's just say it continues about that. We'll do about 80% here. Actually, sorry, that's way too high. 40, 45, 30, 20%. Obviously still the net income is in the negative, so let's change these margins to about 16%. This puts us at, yeah, so there you go. If it was 2.4, that would put it at a $27 stock. Let's just increase that a little bit more to 20%. That's about 3 billion. So if they were to get their previous numbers, this would be a $33 stock, which would mean basically doubling the money, doubling your money in that respect. So it does need to get those previous numbers, and if the call is anything based on what he's saying, then hopefully they can get back to that soon. I'm not going to spend any more time on this because obviously it is negative. Same for the Ben Graham's model. What this is it looks at the earnings per share by growth over the AAA bond yield. So just because I haven't done this in a while, what is the AAA bond yield right now? 4.67. So let me just update my sheet here. And the expected growth of CCL, according to analysts, is over the next 5 years, they're expecting minus 151%. So obviously currently they're not expecting good growth, but if you can see the numbers are all over the place. Next quarter 230%, next year almost 400%. So the numbers are all over the place really. So in that case, I'm going to skip this out because of their negative earnings per share. It's not going to give a positive number. Now the interesting thing here is I wanted to look at the comparable company model. What this does is it looks at a series of ratios: EV to revenue, EV to EBITDA, PE, and it gives a value based on this. So if we look at their more direct competitors, we have two, which is NCLH, which is Norwegian Cruise Lines, and then the other one is RCL, which is Royal Caribbean Cruises. So we can see here that if we look at them, none of them are profitable. Well, Royal Norwegian Cruise is slightly profitable actually because of this number, but we can see it's on the higher side of the EV to revenue, which is we want a low number here. So because they're all sort of all over the place, once again, it's hard to really look at the stock. So what I'm going to do actually is I'm going to look at we'll compare their financial numbers a bit more directly here. So this is Carnival. Currently has about 15 billion in the trailing 12 months. This is Norwegian Cruise, 4.8. And then Royal Caribbean is 8.8. So you can see Carnival is easily the largest. If you look at their profits of a similar time, they were 2 billion in profit at that point. Norwegian Cruise Lines was just under 1 billion, and Carnival was about 3. So Carnival is easily the largest of the cruise liners. If we just do a little compare here between the three stocks, RCL, and we'll add Norwegian Cruise Line, which is NHLC. We'll see how it was affected over the last year. So you can see Carnival was you can see that the dark blue and the light blue, I wish the colors were slightly different. Google, come on, we're using 2 shades of blue here. But anyway, you can see kind of how the stocks have been affected. Royal Caribbean had a pretty strong uprise here, but they've all been pretty sort of tick for tat, with Carnival and Norwegian Cruise being here and Royal Caribbean being at the top. So the question is, can the stock get back to its previous levels? Based on the models, it is not a buy. Based on discounted free cash flow, it's not a buy. Based on the comparables company, it's not a buy. But is it going to get back to its previous numbers? If you are risking and want to gamble, that's what I did on this stock. I bought back in, I suppose, the bottom of end of 21. So I held, and then I've held again. But can we get back up to the previous levels? Right, guys, thanks for watching. Please give a like on the video. Sorry this was a bit all over the place, this video. Need to get back in practice, and I'll catch you guys next time.